I want to welcome you on behalf of our board of directors and the membership. We have been around since 1927, representing the voice of minority banks across this country. And it is with great pleasure today that we present the Conversations in Coffee to talk about issues that can be impactful not only to those who are receiving the information, but also to those who will be giving the information. At this very unfortunate time in the history of the things that are going on in our country, it is conversations like the ones that we're about to have that will be the strength that will tie the fabric together as we as a people move forward in the banking sector. I want to thank both of the organizations who have stepped forward and will plan to participate in this conversation. I think we have Harold Butler from Citi is on tap to speak a little bit later. And also Jim and Robbie, I believe from Deloitte will be participating. And so I want to say thank you to each of you personally. But again, welcome and thank you so much for supporting the National Bankers Association.
Jenna, thank you for that warm welcome. Today is also an exciting day because it's the launch of the NBA's Platinum Partnership with Citi. We are very excited about this new partnership, and I want to extend special thanks and recognition to Natalie Abatamarco and Harold Butler. Harold Butler is the managing director at Citi in their banking, capital markets, and advisory group. Harold and Natalie have been tremendous advocates for our sector, not only during this current time, but also in the past. Harold has been a champion for us. He's been a trendsetter. He has cut the path where it needed to be cut so that we could walk through. And we are very, very grateful to Citi for all that they have done. He is going to provide you with a preview of just a few of the highlights. He can't tell it all, as we say in church. You just can't tell it all. So he's going to give a few highlights of their MDI program and indicate some of the wonderful things that are to come with their platform. So with that, I'll turn it over to Harold. Thank you, Harold.
Well, thank you, Kim, very much for that warm introduction. I actually hope I can live up to that introduction, in fact. And thank you for everyone who's sort of dialed in today on Zoom. I very much we appreciate the opportunity to speak to you. As Kim said, I am Harold Butler, and I am actually responsible for Citi's portfolio of business with the U.S. Department of Treasury and the Federal Reserve System. I have the pleasure of actually leading our initiatives with the minority banking institutions. And I also have the pleasure of several initiatives inside the firm, mainly co-head of diversity and inclusion as part of our banking and capital markets business. So I stay really good and busy. But working with the MDIs obviously is very near and dear to my heart. So again, I appreciate the opportunity to talk a little bit to you about what Citi is and has been doing in this space and how we've responded to some of the events that have sort of gripped us all and are affecting the way we live and work and interact. Of course, I am speaking and referring to COVID and of course the horrific murder of George Floyd that has shocked us all globally and really caused the consciousness of people all over the world to stand up and really think about where we are as a country, as a world. And it has caused corporates, governments, and individuals to reflect then and determine what their role would be and should be to actually help making a change. Citi's strategy began about 3 years ago in partnership with the U.S. Department of Treasury and for what is referred to as the Mentor Protege Initiative. It has grown over the years in part as being informed by some of you out there today, and because we made a very conscious decision at Citi to do those things that would make a meaningful and long-term sustainable impact. So I'll talk a little more about that in just a moment. But what is Citi's action for racial equity? Data tells us that the average Black family in the US has 1/10 the wealth of average white families. According to Citi's latest Global Perspectives and Solutions report, if racial gaps for Black Americans in wages, in housing, in education, and investments are closed today, over 5 trillion could be added to the US GDP over the next 5 years. Some of you may recall in June, as protests for racial justice intensified, our CEO, Mike Corbett, challenged our business leaders to stop and think and to solution how Citi could and might do our part to give voice and action to help changing the narrative. Born from this challenge was the creation of our Action for Racial Equity, which today is delivering more than $1 billion in new strategic value for communities of color. Now, this task force is not just about being philanthropic. It is an important and fundamental way the Citi is engaging and is working to help communities of color build wealth and strong financial futures. I'd like to think that we're addressing the biggest barriers that impede people of color from building generational wealth, to being able to afford to go to college, to buying a new home, a first home, to starting a business, and to saving even for retirement. We believe very strongly that we have a central role to play. And by addressing these barriers, we can make significant impacts in the communities, thus do our part to help close the racial gap. Now, let me talk a little bit about how we're doing this and how we're collaborating with MDIs. I mentioned just a moment ago that our partnership with the US Treasury and what is the Mentor Protege Initiative, this program is based on 2 parts. The first, to educate and facilitate opportunities to do business with the US government. Secondly, to help MDIs to create, drive new wallet opportunities to gain access to tools and knowledge that might help them be more competitive and/or be of greater benefit to the communities they serve. We are delivering on these commitments that we've made and more through our execution of our protege initiatives and through our relationships directly with several MDIs. So, for example, today we are actively discussing with ways to provide up to $50 million in growth capital in a manner that meets and is informed by the MDIs. We know how important fee and interest income are to revenue growth. So we are working on opportunities such as loan participation, credit assignments, supplier financing, and many other creative ways to help grow revenue and provide access to the capital markets. We're changing and creating opportunities for leadership to interface and engage with senior leaders at Citi, sharing best practices and knowledge transfer. We're engaging subject matter experts to work with the MDI teams on efforts such as public affairs, marketing, risk management, cash management, and any other important banking basic function. We are also tackling hard problems such as talent acquisition and access to technology. So clearly you can see we've been busy. And guess what? Along the way, we have achieved a few results. You may recall back in May, we announced a partnership with the National Bankers Association, where Citi created a purchasing facility to assume up to $50 million in PPP loans from the MDIs. This facility purchased about $10.6 million in PPP debt from the balance sheets of MDIs that participated. Industrial Bank, one of our protege banks, our first protege bank, is actually the first and only Black financial institution to participate and drive revenue as a federal government subcontractor. Some of you may have even seen on the news recently on media outlets such as Bloomberg, MSNBC, Fox, and others, where we have created a commercial entitled Open Doors, and Industrial Bank was featured in that commercial. Doyle Mitchell, the CEO of Industrial Bank, talking about the ways that he's impacting through his firm, the communities that he serves, and his partnership with Citi. Unity Bank was our first bank to do PPP debt. And they're also the first bank to engage with Citi on loan participation. We are very, very proud to be working with several other financial institutions, getting them involved in some of the things I've discussed, and even some things that are currently under pilot. Another key area under our Action for Racial Equity is our MDI Technical Assistance Program. We are delighted to collaborate with our longstanding partners from Deloitte to deliver this program. Together, we aim to structure and facilitate technical assistance, training, and other platforms to help MDIs navigate the changing and challenges of the economy, to improve operational efficiencies, and to support talent development. So in summary, these efforts are just part of our collective journey. What's important, most important, is the destination. And for us at Citi, this means doing the things that will make a long-term sustainable impact. We certainly understand the role and responsibility we have in doing our part to close racial wealth gaps and to create racial equity. As we all know, this will require a wide range of approaches and collaborations from all the sectors. So, ladies and gentlemen, it is my pleasure to introduce to you my colleagues from Deloitte, Raj Shah, who is a financial services principal in Deloitte's strategy practice, and Jim Eckenrode, a managing director in Deloitte Centers for Financial Services. These two leading experts will take us through how business strategy will change during the pandemic. Raj, Jim, over to you.
Thank you, Harold, very much. This is Jim. I'll start us off, and certainly we'll bring Raj in as well as we go through the next half hour or so. First off, on behalf of Raj and the entire team here at Deloitte, I really want to thank everyone involved for the opportunity to spend some time with all of you and to share some of our perspectives on what we're seeing in the marketplace and how that relates to strategic planning efforts that I know are underway in all of your institutions today. So we're going to spend a little bit of time to share some of our perspectives along those lines, as well as to give you some of our thoughts about strategic planning itself. Just a couple of housekeeping items before we get started. Although we have a great group on the line here today, the microphones are not going to be open, but that doesn't mean we're not going to ask you to participate. So there are a couple of things that are going to go on over the next half an hour or so, one of which is that we're going to have about 4 polling questions that will appear during parts of our presentation. And we'd love to have your responses to understand the issues that you're dealing with and some of the opportunities that you see before you. So there will be some polling questions. Also at the bottom of your screen, you'll see Q&A. Raj and I will be happy to answer any questions that you might have at the end of our remarks. And so please feel free to click on that link to submit questions throughout the remainder of this presentation. So with that, let me ask to move to the next slide. We're going to start with kind of a macro perspective, give you a sense of what we're seeing in the marketplace on the ground as we're dealing with the very challenging environment that everybody is confronted by today. And then we're going to look at 2 major segments of the business and of the communities that you all serve, the retail customer and the small business customer. Sharing some insights about what we're hearing from them, what their priorities are, what their experiences are, and how those can be best addressed during the pandemic and afterwards as well. And then, as I say, we'll offer some thoughts on strategic planning to help guide you through that exercise, hopefully in the next coming weeks and months. So if we move to the first slide, we've done some forecasting in the Center for Financial Services in conjunction with many of our partners to understand how the pandemic and the economic disruption that has come along with it will be impacting the banking industry here in the United States over the next couple of years. And it's no surprise to anyone, I'm sure, on this call that there's going to be a challenging environment. There is already and will continue to be for quite some period of time. Although loan losses are expected and certainly are being experienced, our forecast suggests that those losses are likely to be less than during the global financial crisis, and that profitability levels as measured by return on equity may not recover until a couple of years from now. Pressure on revenues will continue. Net interest margins especially may be squeezed, but not on the opposite side of the coin, non-interest income could offer some growth potential. And as a result of depressed revenues, efficiency ratios may be challenged in the short term as well. Although loan growth will be suppressed for some period of time, we do foresee a recovery in that, with commercial and industrial being one of the main contributors. And deposits, because of the increased savings rate, as well as decline in overall consumer activity, will likely continue to grow, even in a near zero interest rate environment. And capitalization is one of the bright spots as compared to 2008, and we expect that to continue to be fairly robust. We've just revised some of these forecasts in the last couple of days, and some of the numbers seem to suggest a little bit more optimism. Unemployment rates are not nearly as bad as what we might have expected. Commercial activity, it seems to be picking up, at least for now. We'll have to see what happens through the coming months. But some of these numbers are actually looking a little bit brighter than what's depicted on this screen. So if we move to the next slide, one of the questions that we have asked our clients in a survey that we conducted globally over the summertime that will be featured in our upcoming Banking and Capital Markets Outlook was a question about supporting financial and operational stability. And so what we asked was, what are the main actions that you are going to be taking to preserve that stability over the coming months? Now, what I'm showing you here is a slice of the respondent base that are US bankers, okay? And I think the takeaway that I want to focus on here is that if you look at the top three green bars, obviously a lot of focus on financial stability with rationalization of compensation and headcount, and perhaps repositioning some of that cost savings to implementing technology to drive increased efficiency. Also, perhaps a pursuit of scale economies or divestiture of businesses that are not envisioned to be accretive in the long term. And so pursuing mergers and acquisitions was also identified as a top priority. In contrast, if you look all the way at the bottom, the lowest percentage of net positive responses was in the area of accelerating innovation. And we feel like this is an opportunity to really not only focus on financial and operational stability in the short term, but as you go through your strategic planning, think about where you can innovate to drive growth as we come out of this. Where are the areas where you think you can compete and be successful, and how can you innovate to get there? So I think a mixed and very interesting story in this response. So with that as sort of setting the landscape, Raj, any reaction or commentary on what I just provided here?
No, Jim, I think I think the point about innovation is critical, because the cost of innovation is coming down. So I think from a strategic perspective, it is open to institutions of large and small sizes. Mm-hmm. So that will be one of the interesting questions that we can explore as the presentation goes on.
Great. Thanks, Raj. Okay, let's move to the first section, or the next section, I should say, of our presentation, where we take a deeper dive into the consumer mindset in banking. But before we do that, I think we have a polling question. So let's move ahead. And I think we're going to post a polling question if we could. Here we go. So when you think about digital experiences in your customers, whether they're small business or retail, what are your priorities for elevating that experience? Is it in providing enhanced personalized advice through digital devices, whether they're mobile phones, laptop computers, tablets, whatever? Driving more interactions with staff through digital means? Providing enhanced ability for self-service? Increasing the support for basic transactions, or other? And let's just give you a second to respond and we'll take a look at the answers. I think one of the things that certainly we've seen, and Raj would appreciate your comments here, is that there were a lot of financial institutions in the US and elsewhere that were actively pursuing digital transformation initiatives, investing in technology in a variety of different areas. And the pandemic has certainly accelerated a lot of that. Through the shift to work from home, but also in terms of looking for new ways to provide support to customers. Raj, would you agree with that based on what you're seeing?
Completely agree. Absolutely.
So let's take a look at our responses and then we can get to the next section of the presentation. Self-service. Almost 2/3 of you indicated self-service was the area of greatest priority. And I think a mix beyond that across basic transactions, digital interactions, and personalized advice. That's an interesting point. I'm going to flag that because we're going to come back to that in some of the slides to come. So let's move on to the next slide, where we talk about influencing decisions that consumers make about their financial relationships and particularly their banking relationships. What you'll see when the slide comes up is that location is still very important determining factor when individuals make a choice about their banking relationships. There we go. So on the left-hand side, what you'll see is that across a range of different options, location of bank, the experience with the bank mobile app, larger versus local banks, the number one most cited reason for selecting a bank was the location. Branches and ATMs still matter. And that is reflected even across the generations, where certainly older generations reflect that, but even almost 3/4 of Gen Z and millennials feel the same way. And even those that are digitally inclined, those that primarily interact through the retail website, through mobile applications or other, also view the branch and the location, bank location, as a critical element. So this is something I've been saying for years. The death of the branch is greatly overrated at this point, although they're certainly transforming. And certainly, I think you can take away from this that it is an influencer in individuals making a choice about who they do business with. Having said that, if we move to the next slide, though, COVID-19 has absolutely, as I said before, accelerated the use of digital channels. And this factor is really cited specifically because of the pandemic. 25% of respondents in a survey that we did, that Deloitte did in the April to June timeframe, said that they were going to use mobile or digital tools more often after the crisis subsides. And if you look at various demographics, millennials, Black and African American populations, as well as those living in urban or city locations, even more so, are moving toward digital platforms. So that's an important dynamic that we can't forget about as well. Now, when you talk about the use of digital, it's, I think, inescapable that you're talking also about data about customers and the use of those data, where those data are collected, and what institutions choose to do with them of all types, not just banks, but other providers as well. So if we move to the next slide, another survey that we did about a year or so ago, so previous to the pandemic, reflects this, I think, in a couple of interesting and important dynamics. First, the fact that people don't feel necessarily in control of their personal financial data. They take a proprietary ownership of it. Almost 4 in 10 said that they felt like their personal financial information that belongs to them, not to their bank or anybody else. And only about a third said that they feel completely in control of those data. So there's some uncertainty and some restlessness there with how financial institutions are collecting data and using those data, which some of our research suggests if banks do a good job in disclosing how they're doing that, it actually can be a net positive for that relationship and enhancing trust. And that's reflected in the chart on the right-hand side. In a context and some research that we did about partnerships between banks and other financial institutions, we asked, what type of an organization would you be most comfortable sharing your financial data with that exists within your primary banking relationship? Overwhelmingly, individuals said another bank or a wealth management firm or a retirement plan provider, as opposed to an online retailer, an app or service provider, telecom, or others. So there's a reservoir of trust that exists there within the industry and within the consumer mindset about the industry that I think we need to be aware of as well. Looking outward a little bit more broadly, if we move to the next slide, there are gaps, I think, in the way that consumers perceive various important attributes of their banking relationship and the degree to which the banks meet those expectations, okay? And so what we asked consumers was, how important are these attributes? Trust in keeping my identity secure, competitive pricing, consistent experience across channels, and the rest. How important are those factors to you? That's reflected in the light green bars. So the top 4 there are the most important. Over 7 and 10 placed a high importance on those. In contrast, we also asked them, is your bank currently exceeding your expectation in that regard? And you see the gap there that there's an opportunity to close. Okay, Raj, any thoughts on this?
Jim, I would just say that, we are in this section looking at consumer preferences and recognizing that a lot of the folks listening to us are probably focused on the small business segment. But I think it's worth drawing the parallels that exist between how folks buy or how small businesses and owners buy consumer banking services and small business services.
That's right.
So there are great parallels here. A lot of small businesses and consumers behave very similarly. And we'll come to that in the next section, but that's why this data is so critical.
Yeah, I think that's great context, Raj, and you are going to talk about that just coming up here in a second. Let me close off this section with one final thought for you. As you think about your clients, whether they're small business owners, consumer banking customers, or both, in the case of what Raj said, they're comparing their experiences not only with other banks that they may have relationships, but with all sorts of brands. So if we move to the next slide, one of the other questions that we asked in this survey was, think about your favorite brand, whatever it might be, and tell me about your experience, what we call the emotional connection that you have with those brands, as measured along a number of different statements or dimensions. They wow me with the quality of their products and services. They offer me the most value. They're transparent on fees. They know me and what I need. And then again, we asked them about how they felt about those dynamics with their primary bank. And again, you see some gaps here. So it's worthwhile to keep in mind that your clients, whether they're small business owners or otherwise, are comparing their experiences with a whole array of different service providers that they interact with. More often than not, I should say, that the favorite brands that we asked about were technology companies, but not in all cases. And so the competitive dynamic and the context within which your customers are thinking about their experience extends way beyond the banking industry itself. And they're influenced by that. And I think that's an important dynamic to keep in mind. So that wraps up our consumer section. I think, Raj, you were going to say something?
No, I was just going to say that this is an interesting chart, should be looked at in context with the data that was on a couple of slides ago. which talked about the trust that banks have.
Mhm.
So while your customers might not see you in the same light, see banks in the same light as some of their other trusted brands, they do value the trust and the security that they get from their banking partners. So I think there is some play there that could be capitalized upon.
I completely agree. I think we may have another polling question, Raj. I'm going to turn it over to
I
you
think
for
so.
the next
I think it's
section,
the
but
next
I do
section.
think there is one. Yeah. So
Yeah.
Raj, over to you.
Thank you. Thanks, Jim. I believe we start off with a polling question. So in this section, we are going to go into some of the data around small business segments. We are going to look at what are the requirements for small businesses, how do they choose bankers, how do they choose banking relationships, and so on. So we thought we would just get your early thoughts on what do your customers tell you about why they might choose a bank? And there are a whole host of reasons here that our data analysis, our work with other banks has shown us. So from convenience to service to pricing, of course, and rates, to the product and service offerings, etc. So I think it's open and would love to get the views of the people listening to this call. Shall we see the results?
Yeah, I think that we might be able to do that. There we go.
Fantastic. So I think this is interesting. Customer service is top. I think it kind of correlates well with the first question you had, which was around digital self-service as well. That is one of the priorities that banks have for providing their customers. Fantastic. Let's go to the first slide, which talks a little bit about the segment, the small business segment. I mean, this is a little bit about preaching to the experts here, but it's interesting to look at your total market, addressable market here, because a lot of the folks on the call are clearly focused on the small business segment, and depending on what data one looks at, there are about 24 to 30 million small businesses. They constitute 99% of all businesses in the US. So it's a significant share of the market. One interesting statistic is that 50% of all these businesses are in five industry groupings, if you will: retail services, personal services, construction, and so on. So there is a concentration in terms of what these small businesses provide. They generate 7.5 trillion in annual revenue, which is by any means significant. And the other interesting statistic that I think I would like to draw your attention on is that 75% of these businesses are sole owners, and they constitute 13% of total market revenue. Now, 13% may not look large, but 13% of 7 trillion is still a significant number. And when we say 75% are sole owners, that means that they have no employees or one employee. So it's a real small business segment. Now, the reason why this data is interesting and useful is because all strategy and the theme of the session is strategic planning. And strategy is all about, as you all know, understanding your target, where you want to compete, what does the market look like, where do you want to focus, and aligning your resources and your capabilities and your investment dollars in the right focus areas. So looking at the market, understanding what the market is telling us is clearly important as you folks think about strategic planning. Hence, this gives you a bit of an overlay of the market that you are operating in, which I'm sure most all of you will know. Shall we move to the next page, please? So this is telling us again about and clearly this resonates with the questions that you just answered, but it tells us about what customers value, of course, and what are their selection criteria from a banking partner as businesses grow in size. So at the very left, you have very small businesses, and on the very right, you have businesses that are getting much larger. And clearly, one of the big changes that takes place is the emphasis that businesses place on convenience, in convenience as a selection criteria, as a requirement from their banks. Convenience can be measured in terms of, as you said, digital self-service. It can be measured in terms of the availability of branches, availability of tools that you can integrate with your own back-end systems as a customer, and so on. But that emphasis clearly changes and gets more reduced as businesses get larger. More likely because there are more employees that they can rely on, more infrastructure that they have, and so on. Underwriting clearly is a smaller requirement at the small end of the spectrum, but a couple of things are really important, and again, as you all highlighted, customer service, speed of service, which probably speaks to digitalization, are all kind of constant themes as you go across the spectrum. Jim, anything?
Yeah, I think that's right. And it's really interesting that on the left-hand side, that convenience and service aspect that combines to over 50% is sort of mirrored in that retail presentation about location being important. I think it further amplifies the connection there between the two groups.
Thank you. If we can move to the next page, please. Again, this is an interesting. This is what we were discussing earlier. That that it is clear that small businesses gravitate more towards banks versus non-bank lenders and non-bank institutions. But I think even more interesting, or as interesting from your point of view, from the listener's point of view, is that in most cases, customers tend to gravitate towards the same institution for their retail and business banking relationships, as it says, for convenience, quality, and speed of service. Now, one of the interesting things is, of course, that the top 3 banks account for over 50% of the market, which you all know, of course, and very much driven by this concept of convenience and proximity to physical locations. And on the right-hand side, it gives us, when we ask small businesses for their reasons for selecting the same institution for their both retail and consumer and their business relationships, as I said, convenience, quality, speed of service, knowing the entire relationship, having that holistic view of their personal finances and their business finances clearly played a big role. Commensurately, the same reasons potentially were also cited for having separate relationships in some cases, but it's an 80-20 split here, as you can see. So avoiding that leakage of impact from business to personal and vice versa, getting a bit of diversity in the relationships and so on, but the reasons why folks decided to split the relationship. Jim, any other points?
No, I think you covered it, Raj.
Thank you. If we can move to the next page, please. I would say that this page really talks about some of the pain points that I'm sure your customers talk about, and small businesses struggle with in their day-to-day existence. Some of the things that small businesses really struggle with, that our research shows us, is, you have 75% which are sole owner businesses. So the concept of client concentration is a real danger. The issue around time management is a real danger, is a real issue for them. Managing their cash flow is clearly a high priority. For small businesses, managing growth and driving growth versus quality is clearly a priority. They face key personnel risk, which is real when you have less than 10, 15, 50 employees. And then of course, capabilities such as business planning, marketing, cash flow management are real issues. And I only mention these because they perhaps point to a differentiation of services that banks can look at when you are servicing small businesses. Are these some of the areas where one could focus on to create a differentiated value proposition? So some of these, some of those issues, you can see them translating over here, which cites kind of the key requirements for selecting banks. Time is of the essence. Slow onboarding is clearly a problem. So slow onboarding is an issue. Limited funding. Small businesses often cite the need for having an institution where funding limits are more flexible. Speed of the credit process. Again, given their makeup, they need faster response times. Limited insights and direction. Small businesses absolutely require help with cash flow, about their own business finances and so on. Anything banks can do to help them in this process is highly valued. Real-time information. Again, information about their own finances, but also about the markets in which they are operating in. So industry insight is clearly valued. And I think banks have that ability to provide some of these capabilities. And then time spent on admin. Again, with limited number of employees, it would be very helpful for them to do as little as possible and get some help. Jim, if nothing else, shall we move to the next page?
Well, I think just a quick mention, these companies that are in the middle are all fintechs that have sort of moved in to address some of these frictions, right? And although the pace of new fintech development is very much slowed, many banks are partnering with organizations like this to deliver these kinds of services. And it may be that collectively you may have a similar opportunity to partner with some of these financial technology startups to provide this level of service as well, if you're not already doing so.
Thanks, Jim. If we move to the next page. It's an interesting, the reason why the pandemic has clearly created and has had an incredibly negative impact on small businesses, as we know. But this is an inflection point. And one of the things we realize is that small businesses are very unlikely to switch relationships. So getting small businesses early in their life cycle is clearly important. But there are some inflection points where small businesses do look for switching banks. Some of the obvious ones are when businesses are changing ownership or growing or expanding in different regions. But the pandemic has created one of those inflection points where we see banks being looked at from a small business perspective, looking at who's helped them, where they have been able to get easier credit or easier help. And those are the points where banks need to look at how they might respond to some of their customers and their potential customers in this moment of inflection. Jim?
I would agree with that. COVID-19, as we said in the beginning, is certainly challenging all of us, but I think there's opportunity in this as well, particularly as we look beyond, as we sort of zoom out to the environment that we anticipate may result once we get through the economic disruption that we're in right now. And so these are what we at Deloitte call moments that matter. If we can help them, particularly in these times, it's really important.
And a lot of our clients have seen this as an opportunity to enter new segments, acquire new customers, build new relationships, and solidify existing ones. And so I think this is an interesting point in time.
Yep.
And I think as we move to the next page. Jim, do you want to take this?
Well, I think, Raj, in the interest of time, we can certainly provide these slides, but there are
Yes.
a bunch of ideas that I think are worth considering as we reflect on, Raj, your remarks and some of the things that we've observed, the fact that they use the same retail and commercial bank, that oftentimes bank accounts are opened at the point of company origination, as it says here, and that's a real important another moment that matters. And oftentimes what the research shows is that while banks do switch, or while SMBs do switch around major life events, they also tend to be fairly loyal. So if you can capture them at the point of inception, that's really important, particularly when you see that 10% of small businesses sort of are shut down every year. And so there's this constant replenishment of new entities coming online. And if you can capture those, you may have a customer for a long period of time. So there are a number of ideas here that I think are worth considering. And certainly, as I say, we can provide the slides to you for further reflection.
And then I think we close the section with a final polling question.
That's correct.
Which will come up soon, I hope.
And then we get into the strategy discussion.
Yeah. So now that, I mean, a lot of these challenges that you heard about customers and what customers are looking for, where does the audience feel is the greatest internal challenge in meeting customer needs? We'll give some time for folks to read through.
Just a reminder also that there's a Q&A at the bottom. We do have a couple of questions that have come in. One question I can answer now. The question was about the pain points, Raj, that was cited on a previous slide, and whether or not those are cited in order of frequency or level of pain. I don't believe that's the case. In the research that we've done, these were frequently cited, but I can't tell you for certain if that's the order in which they were presented.
Yeah, I would say
Raj,
that they were the top half a dozen pain points that that businesses have cited.
That's correct.
Absolutely.
Yeah.
Shall we see the results?
Yes.
That's absolutely true. Small businesses do find that large banks are able to provide competitive pricing, and because of multiple reasons, of course, but that I think is one of the key areas where large banks differentiate. But it's not, it's an interesting mix. The top three reasons clearly take the bulk of the responses.
Mm-hmm.
Thank you. So I think the next section we get into, and maybe we'll have to go a little faster and skip a couple of pages, but really on perspectives on strategic planning. And Jim, just keep us honest. If you see any questions come up,
I will do that.
Why don't you kick off, Jim, and then I'll take over.
Yeah, very quickly. One of the other questions that we asked in this Outlook survey that I referenced earlier is just broadly, how well or how strongly do you agree or disagree with the following statements? And this is net positive. So you take all the responses that are agree or strongly agree and subtract from them disagree or strongly disagree. And there's an interesting sort of dichotomy here in that clearly our banking respondents felt that their organizations had a clear plan to maintain operational resiliency. That's the bottom of the two green bars. And yet they also were finding it very difficult to plan where they would invest for future success. So short-term good, long-term we're really struggling. That's all I think I really need to say about that. But I think it's useful as you think about strategic planning and zooming out, thinking about what the environment is likely to be, that will inform that strategic plan. So Raj, back over to you.
Thank you. And to a large degree, this is clearly very obvious that we are all very good at the here and now, and
Right.
much and struggle even in our personal lives on what's going to happen in 1 year or 2 years. And so, that's the reason why planning is important. And here are, what it says here is 90% of strategic plans are never fully implemented. Clearly the best laid plans of mice and men fail, as we say. And people do make very extensive plans and very detailed plans, and then of course fail to meet them. I would say that for the audience that we have here, the top line of these reasons is really important to focus on. And typically what you find is that the assumptions that one makes during the planning process are flawed. And they're flawed because, either you have mistimed, you have misinterpreted some of the data, you have underestimated the impact of certain forces. And so some of the assumptions really need to be pressure tested. A lack of focus or specificity. This is critical. In strategy, one can make broad statements, but the more precise we are, the easier it is to follow, and the easier it is to make course corrections and to test that we are actually meeting our objectives. And then insufficient resources. This is really how I would characterize this as, our eyes are sometimes too big for the appetite. We take on too much. And this is not just for small institutions, but it applies to on personal level, but also to very large institutions. We make grand plans, and then our investment appetite, our ability to dedicate time and effort is clearly not there. And so those are three really critical points that I would like to highlight, because if getting those three building blocks right will really help in the short and medium term. If we go to the next page. So this is a classic, this page could apply, and this process could apply to very large institutions and even very focused and small businesses. And it essentially talks about the choices one has to make when you develop a plan. And the second box really is all around having an explicit statement about where you want to play, in which customer segments, what products, in what geographic areas, what kind of service do you want to provide, and how you want to, and so that is really the critical question that one can answer. And then the next important question is, how will you win in these areas? And what is your value proposition going to be for your customers? And this really gets into some of the other data, some of the other pages that we were discussing. The cost of innovation has come down. The ability to build partnerships with fintechs is real. The democratization of technology is there. So, working with partners in technology firms, the entry point is very low nowadays. Building connectivity amongst a group of banks is really paramount, de rigueur nowadays. As one of the senior bankers said to me, if you are not connected in a network, you're irrelevant. And that applies to a bank which is one of the major US institutions. So it applies equally to smaller institutions. So how will you compete is really the key question once you figure out where you want to really focus. And as I say, taking small steps and making sure that your plans are very bite-sized is going to be the key differentiator. I'll move to the next page. And I will just leave it. This page is, I believe, the final page. Translation, what we call translation of strategy to execution is critical. Build the plans, build your vision, your mission, but then identify as I was saying before, identify the small discrete initiatives, identify the sequence of those initiatives and the resourcing and investment criteria, and look at the ecosystem in which you operate. and explore any partnerships, alliances, connectivity amongst institutions like yours to create that network effect, which will actually in the long, especially now in this, what we call the digital economy, is going to be critical. Jim?
Thank you, Raj. I know we're just about out of time. I believe this is the last slide, and we do have one more question, Kim, before I turn it back over to you.
Yes.
And certainly, please feel free to submit any other questions. But there was one about when I mentioned earlier the actions that were being taken to preserve operational stability. One of the responses was rationalizing assets. And so the question was, what is meant by rationalizing assets? In my view, it could be making decisions about particular kinds of loan books, perhaps that may not be that may warrant a further look. It could pertain to real estate assets, books of business of all types, geographies, perhaps as well. Raj, I don't know if you have any thoughts on that, but it's pretty broad.
It is broad, and I think some of these questions clearly. Some of our questions have gone to large institutions, medium and small institutions. So people answer them in different flavors, depending on their vantage point. But I think from the vantage point of the beholder, if you will, rationalizing assets could be interpreted as really going back to your knitting. So focusing on the areas that you are really good at, that you're operating in the regions in which you operate, and not getting too far away from comfort zones. So that could be one interpretation in the medium to small size businesses, institutions as well.
That's a great point, Raj. All right, that concludes what we have to share with all of you. Kim, let me turn it back over to you. I think we landed the plane just about on time.
Well, thank you. I want to thank Jim and Raj for that very insightful presentation. I know it gave me quite a bit of food for thought, and I'm sure it did for our participants. As you indicated, the timing is perfect as many are engaged right at this time in strategic planning. So we hope that this was invaluable information for you. We want to thank you for joining us today. We hope that you will join us next Tuesday, November 10th at 4 p.m. Eastern for our next session with Deloitte, which will be the impact of COVID-19 and the digitization accelerators. Also, we have breaking news to share with you today. We know that our keynote speaker will be TT Cole, who is the head of global operations and fraud prevention for Citi's global consumer banking, and she's part of their leadership team. So again, we're excited about our next program. We want to thank our speakers today. We want to thank Citi and Deloitte for this partnership, and we look forward to speaking with you next week, next Tuesday at 4 p.m. Be safe and be well. Thank you.